across the pond over at the Federal Reserve, there was another news story that got very little coverage. And that's the fact that the Federal Reserve booked a $126 billion loss in the month of February. That is a staggering amount of money. That is unprecedented. In fact, in 2022, the Federal Reserve had a net profit of 58.4 million for the entire year. Yet they lost more than twice that much in 1 month. In fact, if you look at the biggest gain the Federal Reserve ever achieved in a single year, it was in 2021, where the Fed reported a profit of 104 billion. They lost more than that in February alone. Now, what is the significance of this massive loss? The way it works, when the Fed makes a profit, they pay that profit to the US Treasury. And they've been paying those profits to the Treasury for years, and that has helped reduce our deficits. Now, our deficits are still huge, but they're slightly less huge thanks to the checks that they've been getting for the Federal Reserve. Well, in February, they didn't get a check. They got a $126 billion bill. And now these bills are going to add up because just like when they have a profit, they pay that to the Treasury. When they have a loss, the Treasury has to reimburse the Federal Reserve to make up that loss. So this is going to compound the problems that the Fed has in its inflation fight, because where is the US Treasury going to get the money to pay the Federal Reserve to cover those losses? Because the US Treasury is already running massive deficits. Now they're going to have to run even bigger deficits than the ones they're running. And where are they going to get that money? Ultimately, from the Fed itself. The Fed is going to have to print up extra money so that the Treasury can repay the Federal Reserve for its losses. And believe me, the Fed's losses are just getting started. The Fed is going to break its record, and it's ultimately going to have months where it loses even more than 126 billion. Remember, there were only 28 days in February. And if they can lose 126 billion in 21 days, wonder how much they could lose in March. We got 31 days in this month. The profits that the Fed made during the years of 0% interest rates and quantitative easing sowed the seeds for the much larger losses that it's only now beginning to experience. It's like a massive hedge fund. They made a lot of money when the bubble was inflating, and then they go broke as the air comes out. Well, the Fed can't go broke because the U.S. government is on the hook to cover their losses, which means the American people are the ones that go broke, only they're going to end up paying the price in the form of inflation, higher prices. That is how the American people are going to cover the Fed's losses, by enduring even higher inflation, and they're going to pay the price at the supermarket and the gas station and anywhere they spend rapidly depreciating US dollars. This is just another reason why it's going to be so difficult to put this inflation genie back in the bottle, because ultimately the driving force behind inflation is government debt, because the Fed ends up monetizing it. Well, now, because of the position that the Fed put itself in, debt is going to spiral out of control, which means inflation is going to run away. You know, the ultimate irony is I was listening to an interview on CNBC with Cathie Wood, who always talks her book, and the way she was talking it up on this interview was she claimed that we really didn't have this inflation problem because of technology, and that the government's measures of inflation were inadequate in today's economy. According to Cathie Wood, inflation is actually much lower than what the CPI reveals, and we actually have a lot more economic growth than what we see in this antiquated GDP. So in other words, the government is overstating inflation and understating economic growth, when in fact the opposite is what's true. The government is understating inflation and overstating growth, but Cathie Wood has no clue about that. She's just trying to come up with some way to justify investing in her fund, when the only smart thing to do with the Cathie Wood fund is to sell it, because the longer you hold it, the less it's going to be worth. In fact, it's the share price of a Cathie Wood fund that over the long run is one of the few things that's actually going to go down in price. Now, another thing that's going to buck the inflation trend and fall in price is Bitcoin and other cryptocurrencies. And I mentioned earlier in the podcast that I would get to Bitcoin later in the podcast, and I guess I've reached that point. Last night, Bitcoin did one of its famous mini flash crashes where it dropped about 6% in, I don't know, 5 or 10 minutes. It fell from about 23,400 all the way down to 22,000. And the catalyst that sparked the sell off was the news that Silvergate, and this is the bank that's been having a lot of problems because it's specialized in lending to crypto and other blockchain related companies, is likely to file for bankruptcy. And as a result of that announcement, shares of Silvergate hit a new low today of $4.85. The 52-week high is $162.65. So it's already practically at zero. Now, Silvergate actually managed to rally and close up almost 1% on the day, probably a lot of short covering on this news. But the stock is not out of the woods. I'm sure there's still more downside, especially if they follow through with a bankruptcy, which looks very likely. But all this, of course, should be casting more doubt on the whole idea that this blockchain revolution is changing the world, that this is early in this massive bull market, that institutional money is going to be flooding into the space. How can this premier bank, the bank that was going to bank all of these DeFi companies and blockchain companies, they are on the cutting edge of this new revolution, they've gone bankrupt? This is a massive red flag in a sea of red flags that is a huge warning sign to all potential investors to stay away from this market. The biggest players in this space have gone bankrupt. Sure, Bitcoin itself is still there, Ethereum is still there, but so what? The big money that entered the space is now leaving. The losses are staggering and they're building, and you have all these frauds, and now you have the regulators coming in. It's only a matter of time before the final shoe drops and the bottom drops out of these cryptocurrencies. And I think it's going to happen this year. I think that rally that we had in January is likely to be the swan song for Bitcoin and all the other shit coins that are out there. That was the last chance that people had to get out at a high price. Now, of course, any price is a high price when your ultimate destination is zero, but very few people are going to end up selling into the collapse. They had an opportunity, they had a rally, they could have sold the rip, but now they're going to hold and hope for the mother of all dips. But getting back to other markets, the US dollar index sold off about 70 basis points on the week. It ended last week at 105.20 and closed this week at 104.5. And the dollar weakened despite the backup in interest rates, particularly on the short end of the curve. Now, normally higher short-term interest rates would be bullish for the dollar. The fact that the dollar sold off despite that increase in short-term interest rates may indicate that this correction has run its course and that the dollar has peaked and has now rolled over. And if that is the case, not only do I think the dollar index will sell off to new lows from this particular cycle, but I think it's headed far lower than that. And that is really going to complicate the Fed's effort at trying to bring down inflation, because the weakness in the dollar, I think, is going to be the catalyst for a bigger rally in commodity prices, in particular oil prices, which were also a bit firmer on the week. Oil finished last week at 77.14 and it ended this week at 79.68. So right against that $80 level. But I do think if we do see a breakdown in the dollar, we will see a breakout in crude, and oil prices could lead other commodity prices higher, providing more evidence that the fight against inflation is hardly over. In fact, inflation is likely to counter with the knockout blow, knocking out the economy, the market, and exposing the false narrative that the Fed has conquered inflation and that soon it will be back to 2%. Not only will the inflation is over narrative fall apart, but so will the prospects of a soft landing, the case for which is being constantly disproven not only by the economic data, but by the inverting yield curve. Take a look at what happened to interest rates during the week as short-term rates continued to move higher while the yield on a 30-year US Treasury actually moved lower on the week. In fact, it's the only maturity that saw a decline in yield on the week. The 30-year yield went from 3.94% at the close of last week to 3.88% for the close of this week. Inverting with the 10, the yield on the 10-year inched up from 3.95 to 3.96. So you can earn more interest on a 10-year treasury than you can on a 30-year treasury, despite the fact that a 30-year treasury has 20 more years of inflation risk. Obviously, investors don't perceive any risk for inflation 10 to 30 years out. They just assume that the Fed will succeed by then in reducing inflation back down to 2%. They are completely clueless. But now look at the shorter term maturities. The 5-year yield rose from 4.21 to 4.25. The yield on a 2-year is now at 4.86. A 1-year is 5% even, and a 6-month treasury bill now yields 5.11%. That is the peak of the yield curve. And that means you have an inverted yield curve all the way from 6 months to 30 years, with yields declining consistently the longer the maturity. An inverted yield curve is the most reliable recession indicator that we have, and it is flashing red. And in fact, not only were bond yields up on the week, but look at mortgages. The yield on a 30-year fixed rate mortgage is now back above 7%. This is going to further complicate the problems that are already developing in the housing market. But getting back to the yield curve, the only positive slope left is the difference between the yield on a 3-month treasury bill and a 6-month treasury bill. The yield on a 6-month treasury at 5.11 exceeds the yield on a 3-month treasury at 4.84. But the fact that a 1-year treasury is only 5, what that tells you is that bond investors expect that 6 to 12 months from now, the yields will be lower than they are right now. So not only do investors expect the terminal rate to be achieved within the next 6 months, but sometime between the next 6 months and a year, the markets expect the Fed to begin cutting interest rates. And why do the markets think that the Fed will start cutting interest rates as soon as 6 months from now? Because the markets expect recession. And the markets expect this recession to bring down inflation and result in the Fed pivoting to cut interest rates. What the markets still don't get is that even if we end up in a recession, in fact, even if we end up in a financial crisis, the inflation rate is not coming down. In fact, I believe the next recession will be a catalyst to send inflation to new highs. And so bond market investors should not be buying bonds because inflation is going to come down. They should be selling them because inflation is going to go up. They still don't get the reality of stagflation, and they still don't understand that you can have stronger inflation in a weaker economy. And in fact, this economy is going to be so weak that it's going to supercharge inflation because the Fed is going to be forced to respond not only to the weakness in the economy, but in particular, the weakness in financial markets and the precarious fiscal position of the U.S. government by unleashing massive inflation, maybe even more than unleashed during the lockdown periods of COVID. And that is going to send the inflation rate to new highs and bond prices to new lows. And so the losses that investors suffered last year in bonds, I think, could pale in comparison to the losses they may suffer this year when reality finally sets in and the bond vigilantes wake up.